He's the founder of Dragon Capital, the Vietnamese stock market's largest foreign investor and manager of Vietnam Enterprise Investments. There you go.
Thank you very much, Billy. Sorry, I didn't realise Somerset House, you have to go an awfully long way to find a restroom. Good afternoon to everyone. Thank you for sharing your time. Thank you also to Kepler for organising this. And I've enjoyed the previous two presentations. Not sure if I can match up to it, because all I've got to do is to talk about Vietnam, which seems really quite far away in this big wide world. I've been there 30 years, and this trust, which we call Vale, is 22 years old, or slightly older than that. And so really what I'd like to do, if I may, is just give a few comments about Vietnam, put it in a bit of context, particularly given what we've been hearing about, and talk a little bit about the market and what we do. As Robin said, none of us are here to sell. We're here to inform. So that's the spirit in which I've got a few comments. The trust started in 95, but we had a great idea. We started Dragon in 94. We raised a fund in 95. We thought there'd be a stock market in 96, and we'd all be on the beach in 97. That didn't happen. Of course, the Asian crisis happened, so we had to wait till 2000 for markets. So most of the data points in Vietnam start from 2000. Although, of course, the country, it really dates modern Vietnam from 1990. So we're just sort of celebrating 30 years of modern Vietnam. Anyway, that's the trust. We can come back to that if we want. So what's going on in Vietnam? When I arrived there, first of all, the biggest export was scrap metal in the early 90s. Now, Vietnam's you don't want to use the word cakeism in this country, right? Do you? But Vietnam's core activity is increasing its share of the global cake. Whatever, as both Robin and Ed said, maybe the cake is declining in size, but Vietnam's shape, and that's very visible in the traditional FDI export chain. Demographics, we've been hearing about demographics. Vietnam's 100 million people. It was 66 million people when we started. Population's growing at about 1 million a year. And in fact, the labor force is growing faster than the population as a whole. And that's really what's going on in Indonesia and India and the Philippines as well, I believe. All of that needs infrastructure. And in fact, infrastructure is a very difficult theme to talk about because it's so painfully slow. And I think anybody in this city knows from the Elizabeth line that in practice. But we really need infrastructure in Vietnam, and communists with their pronounced views on accountability are very bad at making public procurement decisions. And finally, the worm, I think, is turning on that in Vietnam. And then we've got this urbanization thing. I mean, references made to China and the Philippines, of course, as well. In Asia, you can't get away from real estate. You could say that probably in this country, in this part of the world as well. But it's, I would echo what Robin was saying, that many Vietnamese people view an apartment as a deposit, and therefore, big apartment buildings are actually quite attractive because there's liquidity, because there's a multitude of apartments. Anyway, urbanization, these four big themes. Go back to that FDI. I mean, one of the core strategies of Vietnam since the Americans removed their embargo in 1994 has been to sign as many trade agreements as possible. They sign them up very easily. And I think Vietnam was the second party to sign with the UK after Brexit last year, a free trade agreement. So they're right in there. And this sort of signifies their outward view. And we've got that. So all of these sort of people have been turning up, and this is a mark on that geopolitical situation we're seeing at the moment. This shows where US imports are coming from and you can see China's obviously dropping over the years, and you can see who's benefiting. It's a range of countries out there. In fact, thanks to Gordon, who's chairman of Vail, and also here with Sarah and Ined. Gordon pulled this out of the FT this morning. I'm sure some of you might have read it. Asia equities will benefit from shift beyond China. Very appropriate comment from his fellow at Bank of Singapore. He picks out India, Indonesia, and Vietnam, which of course slightly coincides with Ed's comments in terms of forward-looking GDP rates. So, how do they all do this? Well, you've got the big companies investing. So Samsung is responsible for 25% of Vietnam's total exports. And Vietnam's total exports are 100% of GDP, and its imports are also about 100% of GDP. So Samsung is exporting 25% of Vietnam's GDP. That's $100 billion a year, mostly in smartphones. And it's followed through. And the names, 15 years ago, it was the sort of subcontractors, and then it became the subcontractors, and then it became the contractors. And now you've got these main brands building their own, moving their own sort of regional operation headquarters to away from China to a number of countries. We get asked, well, how does Vietnam play this? Vietnam's largest trading partner is China. Not surprising, it has about a $40 billion deficit with China. And its second biggest trading partner is the US, with whom it has a $50 billion surplus. So you can clearly see what's happening is while there are these sort of frictions that people don't have too many problems orchestrating their supply routes via the neighbor, Vietnam. And sometimes Vietnamese say, well, they don't find this easy, actually. They don't find it easy at all. One line you hear is that Vietnamese feel that they're too far from heaven and too close to hell. And I think that sums up their nervousness in their geopolitics, anyway. All of that, of course, is pushing Vietnam up the pecking order. We have aspirations to being 19th largest economy in the world, and that's up from 85th largest economy in the world. And that's obviously through GDP per capita. So 100 million people, $450 billion economy, $4,500 per person. That's where China was in, I think, 2010 or 2011 or 2012, somewhere around there. So still in the lower quadrant of Southeast Asian countries. But the rate of change is quite significant. This is consuming people. Rather amazingly, entry-level consumption is $11 to $30 a day in spendable income. Well, you can see that number growing very, very rapidly. And this is part of that urbanization theme. You've got the demographics, you've got the income growth, and you've got the urbanization. These all come together. And we do have Louis Vuitton in Vietnam, but it's really only just beginning. All of this, I think Ed used the word biblical to describe emerging markets. I think that's a very well-chosen word. Volatility is unquestionable in this part of the world. Volatility in Vietnam, it's the most volatile equity market of Southeast Asia. Part of that stems from learning about modern economics. It's not an easy thing to be a bunch of central planned economists and move to engage with a sort of free market world and learn the lessons. And in fact, we've had some painful lessons along the way. The Asian crisis was a painful one. And then the 08-09 crisis was a very painful one. And that's what lies behind. You might have read Vietnam has what passes for an anti-corruption campaign going on, or has been going on. And really what lies behind that is restoring macroeconomic stability, because that is the key to ensuring the credibility of the Communist Party. So you can see for the last 10 years we've had, generally on the right there, lower inflation. We've had a well-managed, we've had actually a very well-managed economy. From being highly speculative, Vietnam is now just speculative. And on the right there, you can see total government debt at 38% of GDP, which in this part of the world looks positively parsimonious. And there are some numbers which we probably know. So looking at the equity market, rate of change. This is a key thing, I think, in that whole emerging market space, is when things happen, they can happen quite quickly. And that, of course, is the flip side of volatility. So 10 years ago, the market was $46 billion. It's now, very considerably 15 times, not 15, 8 times bigger than that. Double the number of companies. And very broad growth in big companies as well, and concomitant sophistication. Vietnam is unfortunately not an emerging market, despite its size. Here you can see where we are in terms of market cap, daily turnover. Vietnam is clearly an emerging market, and most of our investors are there despite it being a frontier market. So the frontier market asset class, some of you might be very familiar with, doesn't really work. It's sort of falling to pieces, I think. And I think Robin pointed out some of the problems, or was it Ed pointing out problems with the MSCI emerging market and the role of China and how that sort of distorts everything. So the whole space from a benchmark asset classification point of view is a bit of a mess right now, frankly. Our own perspective in Vietnam is that it's a big market, trades $750 million a day. And it should be an emerging market, and it isn't because of technical developmental problems, which we can talk about if anybody has any interest. There's the market. Two key drivers really looking for the next few years, looking to 2030, for example. One would be the classification of Vietnam in something more than a little bit of a ignored index, the frontier, which would mean, the World Bank said that if Vietnam were classified as an emerging market, they reckon that $50 billion would be sort of forced or pulled through asset allocation processes into Vietnam. So that's 10% of GDP. That's a significant number. It will happen, but we've been wrong before. My colleagues Rachel and Steve and me, we all have egg on our face for calling this for many years. So we're not putting a date on it, but it'll happen before 2030. And this is the second one. This is a reference to that point that both the previous speakers made about the financial sector and financialization. So credit in Vietnam is not minuscule. It's like 120% of GDP, for example, total credit. Albeit that's, I think China's 350. But what's happening is that when deposits fall into the banking system, deposit rates decline. And so people begin to move that money from their savings pocket to their investment pocket. And we traditionally think savings and investment are the same thing. They're not, of course, they're very different. And so what we've seen here is a massive increase in the participation of the local investor, local retail, local individuals. And we used to have a chart, we don't have it now, but we used to have a chart mapping the Taiwanese experience in the 90s with Vietnam. And you can sort of plot, year on year, the growing participation. This also points out one of the big weaknesses of markets like Vietnam, which is that the retail investor occupies almost all turnover. 2021, 93% of turnover was retail. Last year, something like 80-something% of turnover was retail investors. So that adds to this volatility. But at the end of the day, those two factors, becoming an internationally credible market and participation of local investors, are what affect the way that businesses are valued. So Vietnamese PE ratio is 9. It's traded between 9 and 15 in the last 10 years. Most of the rest of Southeast Asia would be trading, I don't know what they're trading at the moment, but let's say, they're trading at 13, 14, and they trade to 14 to 18. And so what we plan for in our pensions is that process happening over the next few years. So we had a shocker of a year last year, because not only was there the horrible global situation, but Vietnam had a regulatory shakeout. Some of you might have read malfeasance being pinpointed. And the reason was because the regulators or the government woke up. 10 years ago, they were dealing with a crisis, and the stock market was $40 billion, and there was like 300,000 investors in the stock market. Nobody took them very seriously. They woke up last year, and they found then the market was over $300 billion. There was like 6 million investors, and the markets were not that well regulated. So we had a shakeout, which lopped a third off the index and all of our returns. It was a very unpleasant year last year. The bottom was about November with the taking down of a property group linked rather too deeply to a bank. But as you can see, we've sort of headed off the bottom, and we're finding new levels of interest as we come to the half year. And if you look on the left there, you can see that's price to book. The current valuations are a little bit above the bottom of COVID. So I think, as previous speakers have said, you find the upside might require some macro views, a little bit of faith, but the downside would appear to be reasonably limited. As you can see on the right there, flat earnings this year. In fact, I think that's a slightly outdated number, or slightly lower than that, but a recovery from next year. There you can see a few metrics. So that's the macro, that's the market, and then this is us. So there's 1,500 companies. That's a lot of companies, but of course there's a very long tail. So we screen down for size and ownership structure, and we get to a broad universe of just over 200, and then we narrow down to 80 stocks, which we cover in a lot of detail, and build portfolios about 20 to 30 holdings. We used to have a slide with the photographs of all our research colleagues here, on whom we depend enormously, but somebody said that was like a bit too obvious for a headhunter, so we've taken that out. Instead, here's our research platform that we've built. Again, it's too small, you can't see, but this is our own thing. We have target prices, ESG scores, and then company contacts. So that's March, February, January. So we're meeting companies about once a month. And we don't have seats on boards, because that becomes very difficult as an institutional investor. But we have a lot of contact at the sort of as a shareholder. In fact, one of the recent big areas of engagement has actually been, to pick up Robin's point, on paying dividends, because companies have a lot of cash, and they have this atavistic thought that if they pay out dividends, then maybe they won't be able to call for capital. In part, of course, because the retail is such a large part of the market. There aren't sufficient institutions. But Vail, so there we go. Vail's performance. So last year it was down 35%, which was awful. But as of the end of the year, I think it's a 22-year return of 10%, 10% a year. So the sort of 20-year CAGR for Vail, and this is what we achieved to do, it's consistent with what previous speakers have said, is to be somewhere between 10 and 13% a year over a long period. And there you can see over various of the time frames, the figures are probably a bit too small, but I'd concur with, I think it was Ed's comments that Vietnam, I can't speak about other markets, but over those 22 years, it's beaten and NASDAQ and S&P and gold and all share. So, but what of course that means is long term, and I think that comes out from all of these presentations. So we build portfolios in accordance with the big themes. The big themes, none of us need to be rocket scientists to know that, the FDI, trade and demographics and income growth and urbanization and infrastructure, these things are all going on. And as a market, it's a little bit boring when you just look at the sectors. You've got a third in real estate related and a third in banking. So how do you turn? Well, of course, we've got to break down. So when you look at banks, you've got mortgage banks, you've got state-owned banks, you've got banks that pioneer consumer finance, you've got banks that are using, that are right up the digitalization end. So there's different emphases within the banks, and likewise within the property sector, the real estate sector, you've got tourism, you've got industrial estates, you've got residential, you've got sort of luxury faff, and you choose between those. And of course, overriding this, and I think this point has been made, is that avoiding drawdowns, avoiding mistakes is hugely important. And so because the GDP, this point of GDP linking to financial returns is a really important point. And I think one of the reasons it doesn't is because big risks happen because of the volatility. And it could be macro volatility, or it could be volatility at the company level. Bad governance, that's the most obvious one. So screening companies for governance, being engaged, that's a very, very, very important part of what we do. Anyway, there you can see where we are. I echo the point about active investing. Obviously, this is a self-serving comment, but frankly, the prevalence of risk and the difference between good companies and bad companies, and the slings and arrows of volatile liquidity mean that a sort of passive quant type process in these markets really doesn't work. I don't have the charts, but clearly the ETFs are underperformers. This is the portfolio of Vail. 1, 2, and 3 are banks. 4 is steel. 5 and 10 are real estate, housing developers. 7 is tech, and 8 is industrial property, and 9 is gas. Energy, new gas field. 70% of those are private sector companies. But, of our 1,500 companies in the Vietnamese market, roughly half come from state enterprises that have privatized, and roughly half are private sector companies. Forbes has a report on Vietnamese billionaires, and it's covered every quarter very widely in the Vietnamese media. And there's great approbation, great support, and quite a lot of pride that Vietnam has a growing population of billionaires. And so this is a sort of a contrasting point with China, I think, that still in Vietnam there's this idea of the hunger for growth, because Vietnam had a nasty time, as we all know, a horrible time even, to create the modern country. But nobody really would turn the clock back, even though everybody understands that process involved choosing slightly the wrong economic model. And so now there's this very, very rigorous appetite to catch up with the Southeast Asian neighbours. And it's all about the future. I mean, that's one of the great things about being in that part of the world. It's all about the future. So Vietnam's fixed on 2030 because that's near, but it's really fixed on 2045, which is 100 years of independence. And before then, of course, we have 2025, which is 50 years of modern Vietnam. And each one of these points, there'll be a set of KPIs where Vietnam is measured against the big ASEAN 4, as they call it: Philippines, Indonesia, Thailand, and Malaysia, not Singapore, obviously. And so the whole policy slant right now is to favour the private sector. And that is directly linked, of course, to the need for capital markets. So I think that's... what else can I say about the portfolio? There's the P's 10. If you look at, you can't see probably, but this column here is the weight of the holdings and this is the weight in the Vietnam index. These numbers are very different. So that's really echoing this point about active management and conviction bets based on a research-led process. Dragon, that's us. 1994, 200 people, $5 and a bit billion, mostly on behalf, most of that's for international clients, our biggest clients are sovereigns, but endowments, families, and of course, investment institutions. Like everyone, we've been, doing our nutting over ESG, and I just wanted to show this is how we used to have I think everybody's got tons and tons of slides, but the approach that we've taken is here's I don't care at all about, non-financial matters. Here's I don't care at all about profits. And then there are various angles on that. So this is really where we are. It's negative screening, it's integrating this in the process, and it's engagement with companies. That's the core of our approach to ESG. This actually, we find rather easier to do because you don't need any returns. So we sponsor a chair at Exeter University in biodiversity economics, seeking to identify how markets can price the absence of birdsong, which sounds, very academic, but it is quite real. And, that sort of stuff is really very interesting. But that's at the non-investing end, if you like. So what does that mean? So one of the sectors that we have a huge issue with is agro-industry. Because agro-industry is linked to deforestation. It's linked to, the rights of communities. And so these are three companies which we've excluded, to at some discontent from some of the people in the team, because there are some investment merits. But basically, we've excluded these German Deputy Company, Rubber Group, and Agriculture Group because they were heavily involved in deforestation in Laos and Cambodia, and there's been various international NGO inquiries. There we go. I think I'll stop there, if I may. Thank you very much indeed. That's a bit of a ramble through, but we've gone from the big to the focused to the single country. And I hope that we might have time to have a chat later. Thank you all very much indeed for listening.